everyone. A very warm welcome to all for joining us in today's insightful session. It is organized by Corporate Law and Corporate Governance Committee of ICAI. Today's webinar, part of our ongoing webinar series 4, focuses on topic of significant importance in the current corporate landscape, corporate borrowings, governance, disclosure, and regulatory insights. This session will led by our esteemed speaker CA Anil Sarma sir and will be moderated by CA Jatin Furia and myself CA Rupal Haria. Corporate borrowings. It serves as a key instrument of funding growth and optimizing capital structure. At the same time, it demands careful compliance with regulatory provisions, disclosure norms, and governance requirements under various corporates and securities laws. In today's session, we will explore this aspect in depth, understanding the legal framework, procedural requirements, and the best practices that professional needs to follow in managing corporate borrowings and effectively and responsibility also. The Vice Chairman of this committee, CA Preeti Parasavla, marked absence here. Now I am coming to introduce our Chairman of this committee, CLN CGC Committee, CA Babu Abram Sir. CA Babu Abram Sir, Chairman of this committee, is a Central Council member of ICAI and a highly respected professional who qualified as a chartered accountant in 1987. He also serves as the Vice Chairperson of the Audit Committee and Committee of Aggregation of CA firms. His deep understanding of corporate laws and governance has been instrumental in steering several impactful initiatives of this committee. We are privileged to have you and your guidance today. Sir, I request you to address the participants and share your words of wisdom. Over to you, Chairman, sir.
Very good afternoon to all of you. Distinguished resource person of today's fourth webinar series organized by the Corporate Law and Corporate Governance Committee, CA Anil Sharma, who is a very, very distinguished professional with a lot of practical insights and experience into the field, and moderator of today's session, CA Rupal Haria, the Vice Chairperson of the Corporate Law and Corporate Governance Committee, Madam Preeti Savla. She is supposed to join us today, but she is in at another meeting at the Institute. Probably I'm sure she will join us during the course of the session. And Secretary of the CLCGC, Seema Jankit, and very, very respected participants who are joined across the country. I'm sure today we're going to discuss on one of the most vital topics on corporate borrowings, governance and disclosure and regulatory insights. I'm sure there are various modes of borrowing, but as far as corporate borrowings is concerned, I think public deposits play a very key role, and I'm sure the provisions contained in Section 73 to 76 of the Companies Act of 2013, as probably I would say it is very, very stringent penal provisions for wrong acceptance and non-repayment of public deposits, which can have very, very serious consequences for the company as well as for the officers on default. Even at times, you inadvertently also fall into the framework. Say, for example, a share application money, if it is pending allotment beyond a period of 75 days, can assume on the character of a public deposit, and other penal consequences can follow. I think 76A, at times people consider it as very draconian. But this country has seen looting of stakeholders' money, especially the poor public, through public deposits. Therefore, that may be one of the reason the provisions has been made very stringent, even for the company for a fine of not less than 1 crore or twice the deposit amount, or which can extend up to 10 crore, and also for the officers in default, besides penalty ranging from 25 lakhs to 1 crore, 2 crores, it can also go up for imprisonment up to period of 7 years. Therefore, I'm sure all those issues and the practical guidelines on the disclosures and the Companies Act, the Indes and SEBI LODIA guidelines, all those things will be covered by, I'm sure, by our eminent faculty, Anil Sharma. I would also like to take stock of the situation on the challenges faced by the professionals on the filing of the annual forms. It's a major step forward as far as the Ministry of Corporate Affairs is concerned, the launch of the new 38E forms. But we now face some of the challenges in the filing. But my colleagues who has joined us, ICA has taken a special lead in that. ICA has opened 4 dedicated helplines. And these helpline details are available at the CLCGC website. If you are finding any difficulty, please do approach the helpline or send a mail to us. Definitely, we are there to assist you to help. We are also taken up the practical issues with the ministry. And ministry, in fact, we had a meeting day before yesterday with the joint secretary and the service providers to address and understand what are the issues. And I'm sure they have been very, very concerned and assured us that these issues will be sorted out at an early date. And probably we will be also, if the issues persistent continues, then we may ask for an extension of the filing of the forms, even without any additional filing fee. That is also in the pipeline. We are also discussing with the ministry on those aspects too. Once again, thank you. I'm sure you will have a good feast of learning in this session. Thank you very much, my dear colleagues who has joined for this webinar. Over to the moderator.
Thank you, Chairman, sir. It was really insightful, your saying and what committee is doing. Before I move towards introducing our esteemed speaker, I must say to all the participants over here, what committee is doing for the fraternity member, we should take benefit of it. You have highlighted important crucial point, how share application money, if it is not used within 75 days, it will be treated as a deposits and rest other points. And it is commendable efforts and steps have taken to open the helplines. And you have told to all of us that you can mail your practical problems. So this is really commendable and appreciable. Thank you very much, sir. And we all should take benefit of it, because we all are now in the verge of filing annual forms and other forms to ministry. Thank you very much once again, all committees, chairman, sir, and your efforts are really commendable. Now I am moving towards introducing our learned and esteemed speaker, CA Anil Sharma, sir. CA Anil Sharma is a distinguished chartered accountant, bringing with him experience of more than 4 decades, specializing in corporate law, financial reporting, auditing, governance, NBFC regulation, and FEMA compliance. He has served significant roles such as non-executive independent director at UCO Bank from 2016 to 2019, and as a member of the National Financial Reporting Authority between 2020 and 2023. Currently, he is an independent director at Keshav Sahakari Bank and also holds a position as adjunct faculty at the IICA under the Ministry of Corporate Affairs. Beyond his formal role, Mr. Sarma is active in policy and advisory spheres, contributing through institutions like Swadeshi Jagran Manch and supporting NGOs in governance and financial literacy. So, without further delaying, I'm coming to our esteemed speaker, Anil Sarma sir. Now, over to you. Dice is yours. Thank you, everyone.
Thank you very much, and very good afternoon to all of those who have joined this webinar. Respected CA Babu Abrahamji, who is chairman of the committee, and secretary CA Seema Jangirji, and of course my moderator of today's session, Rupal and Jatin Haria. Both of them, I think they are practicing at Mumbai. And all the participants. See, let me at the very beginning confess one point that the topic which has been assigned to me today, which is the corporate borrowings, and where we are looking at the regulatory framework, the disclosure requirement, as well as the governance aspects of corporate borrowings. These are very, very vast subjects. And each one of them, I mean, corporate borrowings, if we just talk about purely the regulatory requirements, we talk about purely about the disclosure requirements, and we talk about purely the governance part of it. These itself are, a separate topics for webinar of 2 to 3 hours each. So, with this background, what I'm trying to say that I would be giving a overview of almost all aspects of this topic, and during question answer session, you can raise any technical questions if you have. You can very well raise that point. And I would suggest the committee to to ensure that if all the participants suggest, you can have separate webinars on each aspect of this particular topic. So that was my one suggestion. Now, as rightly pointed out by the worthy chairman of the committee, that corporate borrowings is a really a very, very important aspect where the corporates raise money from the public, from banks, and from private resources. And it requires very serious kind of governance as well as regulation for that purpose. And of course, the stakeholders would require to know that how those borrowings are being used and in their financial statement by the company. So from that point of view, I would say that definitely it is a very, very vital topic. So I have a presentation, so I'll take you through with that presentation so that we can complete this within a very given timeline, and then we'll definitely have sufficient time for question and answers. Sorry, I have to see where it has gone. Please give me 1 minute. I don't know where. Yeah. Okay. Is it visible?
No, no.
Not visible, sir.
Not visible.
It,
Okay.
it to load the screen.
Sorry, just give me 1 minute. Let me come back. I will be rejoining. Let me first go out and then I'll come back.
In case you want, sir, we can share this, forward it to us. We'll share the screen.
From here.
No, it's okay. I'll just. Yeah, is it visible now?
Now it is visible. Yeah.
Thank you. Okay, so sorry for this little glitch on technical part. So I was onto this corporate borrowings. You see, if you look at the very nature of these borrowings, these can be secured borrowings. It can be unsecured also, and there are a number of sources from where businesses borrow these funds, and the purpose of raising these resources is also quite vast. Sometimes they are used for expansion. Sometimes it is used for their working capital requirements. So accordingly, the nature of these corporate borrowings are long-term, short-term, and then again, the sources can be domestic sources. There can be international sources also. As have been seen, the commercial banks and financial institutions continue to be the prime source of corporate funding in India. And of course, unsecured loans and bond market has also become quite popular these days. The various statutes has provision for other sources from where corporates can raise their the borrowings, and I would be discussing all of them. So, and my presentation is virtually like in a stages. First, I would be talking about the regulatory part, and then we will look at the disclosure requirements, and then of course the governance aspects of corporate borrowings. So I have prepared my presentation in that particular order. So when we talk about the regulatory framework for corporate borrowing, you can very well see that there are three important statutes which govern this. The very first is the Companies Act 2013. Then there are various regulations which has been framed under SEBI Act, which are primarily for the listed companies. And then if the corporates are raising borrowings from international sources, then there is a regulation framed under Foreign Exchange Management Act. So we would be concentrating on primarily these three acts. So the very first common point in all these three acts is, if you really analyze the regulatory framework, the only objective or the prime objective of these legal provision is to safeguard the interests of shareholders, creditors, and the company itself by ensuring proper management of borrowings and debts. So with that idea that how much company should borrow, from where it should borrow, what should be the process, who is authorized to borrow, all those aspects are covered in these directions. So let's start with the Companies Act first. There is you can divide the regulatory framework into primarily in three parts. First is the power of the company to borrow. And for that, we can look at Section 4 and Section 5. Section 4 deals with the memorandum of association of the company, and Section 5 deals with articles of association. Then we have Section 179 and Section 180, which governs the borrowing powers of the board of directors of a company. And there are number of nature of borrowings which are governed. So, for example, Section 71 deals with the debentures. Section 73, 76A deals with public deposit. Chairman sir has elaborated various aspects of this section also. Then borrowing from banks and institutions, intercorporate loans, and loan from directors. These are also covered. Part of these are covered in Section 73 to 76 itself. So I would say that these are nature of borrowings which are governed in under various provisions in the Companies Act. Let's start with the very basic one. See, it is a very interesting provision, but with my personal experience, I'm telling you that a very large number of times we have seen that some of the companies which have been incorporated, sometime initially they don't have these provisions. So first of all, if you look at the memorandum of association, and when you look at the object clause of that, so objects, it has main objects, and then it also has other incidental matters to carry out the main objects. So you have to be very careful and see that for the borrowings of the company, to authorize company to borrow, in the part B of the object clause, there has to be very specific provision that company would be allowed to borrow funds for its business activities as may be provided or as may be provided in the articles of association of the company. So the very first scope has to be there in the memorandum of association in object clause itself. Then in the articles of association, which is primarily the rules and bylaws and regulation through which the board carried out its activities. For that, you can also refer Table F in Schedule 1 to the Companies Act 2013. You will invariably find a borrowing power heading in the articles of association, where in general terms it must be there that the board of directors is authorized to borrow. So that is the first two very important steps. Number of times I have seen when the companies go to the banks for obtaining any borrowings from them. So they always first ask the companies to provide them a copy of memorandum of association and articles of association, because first they want to see that these two conditions are there, whether the company is allowed to borrow, and if allowed, then what are the regulations, if any, which are provided in the articles of association. The very basic point. Next point, let's go to Section 179, which is again a very relevant section, and which is the most important regulatory aspect with regard to the corporate borrowings. So Section 179 is a section which the very heading of that section is restriction on powers of the board. So this section says that company shall be entitled to exercise all such power and do all such and things as the company is authorized to exercise and do. Now you can see here how it is linked to section 4 and 5, that power which is given in the articles of association or memorandum in both. So this then it leads to section 179, said that since all the activities of the companies are carried out through the board of directors, so section 179 says that in the case of the board of directors of a company, whether a private company or a public company, they will exercise some specific powers only by means of resolution passed at the meeting of the board. So it means that these are those resolutions which are has to be where all the board has to be present, and they cannot be passed through circular by circulation. So that is the main requirement. And if you look at the clause D of subsection 3 of section 179, it says that the board can borrow monies only with the approval of the board of directors at its meeting. So to the the overall reading of this section is that section clause D of subsection 3 of 179 requires that the borrowing the board can exercise its power to borrow money only with the approval of the board of directors, for which a resolution is passed at its meeting and not through a resolution by circulation. So that's the first important requirement. Then this section goes further. It gives some exceptions. It says that in the case of a specified type of companies, which are IFSC private company or IFSC public company or section 8 company, they are the companies who can also pass resolution to borrow by circulation also. So that's the only exception in this particular section. Coming to section 180, this is the borrowing power of the board. In fact, you can read section 180 before reading 179. Anyhow, so section 180 relate to restriction on power of the board of directors. So the section requires that the board of directors company shall exercise certain powers only with the consent of the company by a special resolution. The first was the section 179 was borrowing power within the board, by the board. Now it is coming to then when a board, what are those requirements where even board has to come back to the members of the company to borrow, and for that purpose they have to take this consent of the company by passing a special resolution in general meeting. So what are those? Section 180 says that when that is required, when the company to be borrowed, when the amount to be borrowed together with the money already borrowed by the company exceeds aggregates of its paid up share capital and free reserve and security premium. So this is the threshold which has been given. So paid up share capital, free reserves and security premiums. Again, all these terms are well-defined terms, so there should not be any confusion so far as these terms are concerned. So this is a threshold which has been given. Of course, for so far as borrowing monies are concerned, here one exclusion is there, that temporary loans obtained by the company's banker in the ordinary course of business, temporary loans, even cash credit limits are, since they are repayable on demand, so or that way, so those are not to be considered while looking at this threshold limit as prescribed in clause C of this section. So that is the second regulatory requirement under section 180. Of course, there are two exceptions. One is private companies, unless they are subsidiaries of public companies. then they are also exempt from this requirement. And similarly, unlisted public companies, which is licensed to operate by the RBI or SEBI or IRDAI from IFSC, located in approved multi-service special economic zone. So like Gift City and all from all those places, unlisted public companies. So in IFSC, they are also exempt from the provision of section 180. Rest all are. Now let us look at some of the specific provision. These were the general restrictions on the power of the section power of the board to borrow, section 179 and 180. Now let us look at some specific provisions with regard to see a nature of a specific type of corporate borrowings. One of them is debenture. So section 2 clause 30 defines debenture. It says that a debenture includes debenture stock, bonds, or any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. It means whether these debentures can be secured or unsecured also. So a debenture is a document issued under the seal of the company. It is an acknowledgement of the loan received by the company equal to the nominal value of the debenture. So this debenture also bears the date of redemption, rate, and mode of payment of interest. Of course, as per the requirement of other Stamp Act and all, these debentures are also required to be stamped. Section 71 deals with various conditions for issuing debentures. So see this again very detailed section, but I can point out few important conditions. The very first is the company will not issue any debenture that carry any voting rights. So that is the first condition. Then no company will issue a prospectus or make an offer or an invitation to the public or its member in excess of 500 for the subscription of his debenture. So maximum, without going into the listing requirement, so the maximum limit is 500 to whom they can issue the prospectus for subscription. So unless the company has previous to such issue or offer selected one or more debenture trustees and the prescribed conditions that govern the appointment of trustees. So the very debenture trustees has to be appointed. Debenture trustee will take step to and they're the debenture trustees which are going to be appointed. The important duty which has been assigned to them is to protect the interests of the debenture holders and ensure that if there is any grievance raised by them, they are properly addressed and taken care. Any provision of trust deed or contract that is protected by trust deed, exempting a trustee or indemnifying him against any liability for violating a trust will be void. So that's a very serious provision which has been put into this section. Because you see, once debenture trustee is appointed, so he has been given a very important duties. So and for that there should not be any clause in the trust deed where it can say that trustee will not be responsible for violation of trust. Any provision of the trust, this debenture trust deed, if it is there. So that clause would not be, even if it is there, it will be void because that section 71 doesn't permit that. Quickly talking about the procedures, again, it's a very detailed process, but let's have a quick understanding of the process to issue debentures. The board meeting has to be called to make a decision which type of debentures will be issued by the company. It means whether it is going to be secured, unsecured, or then they would also see appointment of debenture trustee agreement, appointment of debenture trustees, then authorizing for creation of charge on the asset of the company if they are secured debentures, and to agree to debenture subscription agreement, fixed day, date, time, and all these are matters which has to be first decided by the board, and then they would be placed before the extraordinary general meeting of the shareholders for its approval. So this is going to be a special resolution to issue debentures. So as you know, that special resolution has a specific requirement of having a detailed, first of all, it has to be passed with the absolute majority, and then the explanatory note explaining the background, giving the entire gamut of background of issuing debentures, and all that has to be given. So then these documents required, and then prepare and file document ROC, and once the allotment is done, then the company is supposed to issue certificate of debenture within 6 months from the date of allocation. So these are some of the important steps, procedural steps in issuing debentures. So let's move to the second type of corporate borrowing under the Companies Act, as specifically referred in the Companies Act, and that is public deposits. So Section 73 to Section 76A, these are the sections which govern public deposits. So Section 2, Clause 31 defines deposit. It says that deposit includes any receipt of money by way of deposit or loan in any other form by a company, but does not include such category of amount as may be prescribed in consultation with the Reserve Bank of India. So it means though the definition of deposit is very wide, which includes any receipt of money by the company, but the section gives powers to the central government to exclude certain categories of amount to be considered as public deposit, and that they do in consultation with the Reserve Bank of India. So those exemptions or those exceptions have been prescribed through the Companies Acceptance of Deposit Rules 2014. These rules also prescribe the entire process when how public deposit can be raised, what are the formalities, and then this. So let's look at these rules a little bit, because some of them are important one and are being used by the companies very regularly. So all those deposits which has been excluded as to be considered as public deposits, we can classify them as, say, exempt deposits, and all other public deposits may be considered as regulated deposits. It will be easier for us to. So first let's look at exempt deposits. Any amount received by a company from any other company. Normally we use the term intercorporate deposit. So this category is exempt deposit, and it will not be regulated by the Companies Acceptance of Deposit Rules 2014. Similarly, fully secured bonds, debentures, fully secured debentures, provided the amount of such bonds and debentures shall not exceed the market value of such assets as assessed by a registered valuer. This is important, that when we say fully secured, they should be actually fully secured, and that can be seen, that has to be seen from a report of the market value of the assets against which they are being considered as secured, and a registered valuer's report would be required for that purpose. Compulsory convertible bonds and debentures, provided they are compulsorily converted in next 5 years. Amount received against issue of commercial paper. These are special facility which has been given to non-banking financial companies, where RBI guidelines allow them to raise funds by issuing commercial papers. So those are also exempt deposit. Interest-free amount received from employees as non-interest bearing security not exceeding his annual salary. This is also a exempt deposit. There are certain other exempt deposits, but with some conditions. Let me give you one or two example of that. So, and then please be very careful about the conditions which are attached to it, because sometime in practice I have seen that the second part, which is the conditional part of treating this deposit as exempt, is not followed properly. So any amount received from a person who at the time of receipt of the amount was a director of the company. So very carefully you can see the person should be a director at the time when the amount was received from him. That is the first condition. Second is the director from whom money is received, he has to furnish the company when he is giving the money a declaration in writing that the amount is not being given out of funds acquired by him by borrowing or accepting loans or deposits from others. So it should not be a situation where the deposits or loans taken by the directors are taken by the company, routed through the directors. To avoid that situation, this declaration has to be given by the director that he is giving these funds not out of borrowed funds. This is very important, and only then it will be considered as exempt deposits. So this is one. Another example is there are loans from promoters are also exempt in certain situations. What are those situations? An amount brought in by the promoters by way of unsecured loan in pursuance of the stipulation of any lending institution or bank, subject to fulfillment of certain conditions, which includes the loan is brought in pursuance of a stipulation imposed by the lending institution. If it is part of the sanction letter itself that promoters has to bring in so much money. So promoters, even if they are not directors, then any deposit from them would be exempt deposit till that time. The exemption is available only till the loan of an institution or banks are repaid, and not thereafter. The loans are provided by the promoters themselves or by their relatives or by the both. So it's but the only condition is that it is as per the stipulation of the lending institution or bank, whosoever is making it as a part of a sanction of the loan. Only then this would be an exempt deposit, and only up to the time till the loan is still outstanding. So that's another exempt deposit with condition. Third, another, or I would say 2-3 more type of exempt deposit can be seen as received in the advances received in the ordinary course of business, advance for supply of goods and services. However, if not appropriated within 365 days from the date of receipt, shall be considered as deposits. Now, some of these conditions looks very simple, but let me explain to you that it has got a lot of responsibility onto the management, as well as onto the directors, as well as onto the auditors, to ensure that these conditions are not violated. For example, I am talking about this: if not appropriated within 365 days, then this would be considered as deposit. So once it is considered deposit, then all the provisions which are relating to the public deposit would be applicable, and accordingly company has to really see that those are complied with. Because when we were talking about the various sections, especially when we were talking about section 76A, where it is talking about the penalty part. So all of a sudden you find that the company is responsible for a lot of penalty if these small things are not timely taken care of. Similarly, amount received as security deposit for the performance of the contract for supply for goods or provision of services. This again, this should be very has to be seen very carefully, that these are not this route should not be used as a camouflage to accept deposit from public. The nexus between supply of goods or provision of services has to be there wherever this such type of security deposits have been obtained from the service provider or supplier of the goods. Third one, I think there was a mention of this security application money also. So now we use the word securities application money. If securities are not allotted within 60 days and thereafter the money is not refunded in next 15 days, it shall be reconsidered as a regulated deposit. So you can, once again, I am not going to repeat that. So these are few conditions, where strict compliances has to be there to avoid any penal provision. Coming to the regulated deposit part, those were the exempt deposit. Now let's look at regulated deposits. So these section 73 to 76A, which is the entire provision relating to public deposits, it visualizes regulated deposit in two ways. One is which are deposit from the members of the company. Again, there is no, in this case, there is no distinction of private or public companies. Whereas deposit from public, then it is very strictly only for the public companies, and only those public companies which are eligible. And the eligibility criteria is given in the in various sections and rules. So let's look at important things, few important points, especially when it is applicable to both types of regulated deposit, for members as well as from public. It says that no company shall accept or renew any deposit, whether secured or unsecured, which is repayable on demand or within a period of less than 6 months or more than 36 months. So the timeline is there. Repayable on demand cannot be issued, cannot be accepted, and similarly less than 6 months and more than 36 months. Provided that the company may, for the purpose of the exception to this rule, is that for short-term requirement of funds, the company can still take deposits from its members. Take from members as well as from public, subject to the condition that first of all, if we're taking from public, then eligibility criteria is met. And then such deposit shall not exceed 10% of the aggregate of the paid up share capital and free reserve of the company. And such deposits are repayable not earlier than 3 months from the date of such deposit or renewal therefrom. So you can see here, so for 3 months, from 3 to 6 months, this temporary, where the less than 6 months is the condition, but here for short-term provisions, 3 months period can also be, for 3 months period also can be taken, but not less than 3 months is not permitted. And similarly, on demand, which are repayable on demand, are also not permitted. Another condition is with regard to rate of interest, again, which is applicable to both types of deposit, whether accepted from members or as well as from public. So here they have put a ceiling of rate of interest, as well as if any brokerage is being paid for raising these deposits, then the Rule 3, Sub-Rule 6 has put some ceiling. It says that what are the ceilings which are applicable to non-banking financial companies would also be applied to for these companies here. And the ceiling for NBFCs is rate of interest 12.5%. That is the maximum. Interest can be compounded on monthly rates. And brokerage, commission, and incentive, whatever name you can give it, 2% of the deposit collected. That's a maximum which a company can pay for helping the company to raise these funds. Now, let us look at some of the provisions which are specifically for deposit from members, which is a regulated deposit, but from members. So first of all, a company has to pass a special resolution in the general meeting, and the maximum amount which can be accepted here from deposit from members under Section 73 is 25% of the aggregate of its paid up share capital and free reserves. So that's the maximum amount which can be raised from members. And some of the other important conditions, or rather steps, which are required to be taken and which are being considered as their conditions, that first of all, issuance of a circular to its member, where the company has to give the very detailed information: what is the financial position, what is the credit rating which has been obtained, how many total number of depositors are there, how much amount due towards deposit in respect of previous deposits accepted by the company. And then all these circulars which are being given to the prospective deposit holders, depositors, that is also required to be filed with the registrar of companies within 30 days before the date of issue of the circular, and only then it goes to the members for inviting deposits. Depositing such amount which shall not be less than 15%. So this is every year, whatever is due next, 15% of that has to be kept as a margin, and it has to be kept in a scheduled bank in a separate bank account, which will be called deposit repayment reserve account, and can be used only for the purpose of repayment of deposits. And then there is also a provision for insurance of deposits as prescribed in the rules. Now let's come to the last part so far as public deposits are concerned. These are deposits from public. So first of all, as I mentioned to you, that public deposits can be accepted by only a public company, which is a eligible company. And the criteria to be considered as a eligible company is given in explanation E to Rule 2 of the company's acceptance of deposit rules. So it says that the company should have a net worth of not less than 100 crore rupees, turnover not less than 500 crore rupees, and the company which has obtained the prior consent of the company in general meeting by special resolution, and that resolution has already been filed, provided an eligible company which is accepting deposit within the limits specified in may accept deposit by means of ordinary resolution. That is the up to a particular level, up to its paid up share capital, free reserves, and share premium account. To that extent, even ordinary resolution is okay. Beyond that amount, it has to be a special resolution. So this is the requirement with regard to. Then Section 76 also requires a eligible company before it accepts public deposit to obtain a rating, which rating will certify its net worth, liquidity, and ability to pay its deposit on due dates. And it has to be obtained from a recognized crediting agency, which is this rating is for the deposits. And very specifically, the rating should say about that this rating is for deposit and not for other purposes. Shall be obtained for every year during the tenure of the deposit. And then the company has to create a charge on its asset on the amount of not less than the amount of deposit accepted in favor of deposit holders. And this charge has to be filed within 30 days from acceptance of those secured deposits, if a company accepts secured deposits. This is again is only applicable when there is a secured deposits. On the eligibility criteria, then Rule 3, Sub-Rule 4, any deposit from its member shall not exceed 10% of the aggregate. And any other deposit, so it means the overall limit is 35%. 10% can be from the members, and from public it can be 25%. So overall 35% limit, which is based on paid up share capital and free reserves of the company. So these were, I would say, primarily debentures, public deposits, and then we talked about the Section 179 and 180, and those were the regulatory framework so far as corporate borrowing under the Companies Act. Now let's move to the second type of borrowings, which is the corporate borrowings under the SEBI Act. Now, these are again as very clear that these are those situations where these are applicable to only listed entities, and there also it is these guidelines are there for large corporates. So for that you have to look at the Securities Exchange Board of India revised framework for borrowing by large corporates. This was made effective from 1st April 2024, and this applies to all listed entities except scheduled commercial banks. Now, as per these revised framework, the large corporates are those listed entities where which are having outstanding long-term borrowing of rupees 1,000 crore and above, and a credit rating agency, credit rating of AA, AA plus, or AAA. So those are the basic criteria. Also, large corporate list their non-convertible redeemable preference shares, debt, and specified securities on a recognized stock exchange. So now let us look at the various important issues with regard to this revised framework for borrowing by large corporates. So large corporates can raise at least 25% of incremental or qualified borrowing in a financial year. So this is on year-to-year basis. Fundraising is accompanied by issuing debt security in the financial year after the end of the financial year when the entity was first identified as a large corporate. So that is one condition. Then the outstanding long-term borrowings, including outstanding borrowings with an original maturity of more than 1 year. In that situation, one has to see that these borrowings, what we are talking about here, there are certain exclusions which are outside the long-term borrowings, and these are external commercial borrowings, ECB, intercorporate loans, grants, deposits, and other funds received from the government of India, interest capitalization borrowings, and borrowings for mergers, acquisition, and takeovers. These are will not be considered as the outstanding long-term borrowing to look at the total fund which can be raised by large corporates. And then, of course, there are other regulatory parts on so far as LOD are related that I will discuss a little later when we talk about the governance part of it. Now, let's look at move to corporate borrowing from international sources. And for that purpose, we have to look at certain regulations, which is Foreign Exchange Management, Borrowing and Lending in Foreign Exchange Regulation 2018, or normally we call it Notification FEMA 3 revised. Similarly, then there is another Foreign Exchange Management Guarantee Regulations 2000, which is FEMA 8. Then along with that, overall, there is a external commercial borrowing and trade credits policy is there, which was issued in 2019 and it has been updated as latest as June 26th, 2023. So those are the, I would say, the various statutory provisions which has to look at for corporate borrowing from international sources. Let me give you a little bit important provisions relating to external commercial borrowing. So these are what is external commercial borrowing? These are commercial loans which may be denominated in foreign currency, or they may be denominated in INR. These are raised by eligible resident entities and from recognized non-resident entities. And then so first of all, so what is there that ECB cannot be raised by any resident entity. It has to be a eligible resident entity, or we call it eligible borrowers. That I will explain you. There is a separate slide for that. And similarly, from where they can raise those funds, they are called recognized lenders, recognized non-resident entities. And then these ECBs should conform to 3 important parameters. There are others also, but 3 are very important. One is the minimum maturity, then permitted and non-permitted end uses, and maximum overall all-in cost ceilings on the cost, etc. So these are 3 parameters which has to be met for raising external commercial borrowing. So let me clarify here itself the number of times your banks through your authorized dealer category 1 banks, they give you domestically to companies, they give foreign currency loans, which they give out of their proceeds of FCNRB deposits, but they would not be considered as a part of this ECB. They are separate. Because for that purpose, banks are using their resources to give you those foreign currency loans. So let's look at some of them one by one. Commercial loans, which are denominated in foreign currency. So first of all, the currency which should be denominated should be a freely convertible foreign currency. And all kinds of loan can be there. It can be floating, fixed rates, bonds, debentures, trade credits beyond 3 years, foreign currency, convertible bonds, foreign currency, exchangeable bonds, and financial lease. These are type of loans which are covered as commercial loan denominated in foreign currency so far as ECB is concerned. And then commercial loans which are denominated in INR. These are loans which include, again, same, it can be floating, fixed rate notes, bonds, debentures, preferentials, other than fully and compulsorily convertible instruments, trade credits beyond 3 years, financial leases. And then another very important type of commercial loan, which is INR denominated, is called plain vanilla rupee denominated bonds, which are issued overseas, which can either be placed privately or listed on exchanges as per host country's regulation. Now, since this is an important one and a lot of corporates are using this particular mode of ECB, so three more important points here. What is plain vanilla bonds? It is also called masala bonds. So first of all, there is a fixed coupon payment at predetermined fixed intervals. The maturity of the bond is also predetermined. The face value of the bond is also predetermined. The issuer redeems the bond at face value on the date of maturity. So these are, you can see from these conditions that these are the most suitable condition for raising ECB, because here the borrower is not subject to variation or in the exchange, foreign exchange rates and all that. So from that point of view, it is a very most prevalent or very good source of raising external commercial borrowing. Now let's talk about who are the eligible borrowers, who can borrow, who can raise external commercial borrowing. When the external commercial borrowing is denominated in foreign currency, then all entities eligible to receive FDI. So for that, you have to look at who are eligible to raise FDI. So all those entities, ports, trust, units in SEZ, and then CDB and bank, we can leave those. Similarly, in the case of when the borrowing is INR denominated, all entities eligible to raise foreign currency denominated ECB. So it means the left side, all entities. And in addition to that, they have also allowed registered entities which are engaged in microfinance activity, registered not-for-profit companies, registered societies, trust, corporate, and all that. So they can also raise INR denominated ECB. And the recognized lenders, there are certain conditions from whom external commercial borrowing can be raised. The very first is that the lender should be a resident of FATF compliant country. He should not be from a country which is not registered with or which has been which has been debarred by FATF. Then multilateral and regional financial institution where India is a member country. All those institutions are recognized lenders. Individuals and lender can only be permitted if they are foreign equity holders and for subscription to bonds and listed abroad. So if you want to raise this ECB from individuals, so these are the two conditions, that they are foreign equity holders, or they have subscribed to bonds and debentures listed abroad by the company, or GDR, what we call global depository receipts, which are there, or foreign branches, subsidiary of Indian banks. They can only give foreign currency ECB. Then foreign branches, subsidiary of Indian banks. Then they can also participate as arranger, underwriter, market makers, traders for rupee denominated bonds issued overseas. So far as foreign currency denominated ECB is concerned, foreign branches, subsidiary of Indian banks will be considered as recognized lenders, but for INR denominated ECB, they can act as a arranger or underwriter, but not as a lender themselves. So these are the conditions. Now, the three parameters which I was talking about, let's quickly look at them. First, it says that minimum average maturity period will be 3 years, and call and put options shall not be exercisable. If those are there, then prior to completion of minimum average maturity. Minimum average maturity, we say that if the funds has been raised in stages, so then for that purpose there is a way to calculate minimum average maturity, and accordingly this 3 years period will be seen. However, if the ECB has been raised for specific use, the MAPF will be prescribed therein. For example, if ECB has been raised to acquire, let's say, a fixed asset or a property, plant and equipment, then it can be there can be the agreement itself can provide that how this will be paid, and for that this 3 years minimum average maturity period would not apply there. The prescribed MAMP will have to be strictly complied with under all circumstances. There's one condition. Permitted use. Now, in the use itself, and this use is linked to MAMP also. ECB raised by manufacturing companies up to USD 50 millions or its equivalent per financial year, then MAMP of 1 year is it should be there. That is another. If MAMP is of 5 years, ECB raised from foreign equity holders for working capital purposes, general corporate purposes, or for repayment of rupee loan. So there MAMP has to be 5 years. Similarly, ECB raised for working capital purpose or general capital purpose on lending by NBFCs for working capital purpose, then the MAMP has to be 10 years. So these type of limits are there. You can see here. Rupee loans availed domestically for capital expenditure, then 7 years. Repayment of rupee loan domestically for purpose other than capital expenditure, then 10 years. These are another parameter which one can see. These are all part of the regulation which I just mentioned. End use, for which ECB cannot be raised, are important to know. Real estate activities, investment in capital market, equity investment, working capital purposes, except in case of foreign equity holders, except ECB, raised from foreign equity holders. Then general corporate purpose, except in case of, so when it is raised from foreign equity holder, then even working capital purpose and general corporate purpose is also can also be there. Repayment of rupee loan, for payment of repayment of rupee loan, then on lending to entities for any of these above activities is also not permitted, except in case of ECB raised by NBFCs. So because ultimately the objective of the NBFC is to give loan. So if they have been, after complying with other conditions, if they are permitted to raise, then they are also permitted to give it on lending to other entities. And ECB proceeds cannot be used for payment of interest and charges. That's for that purpose. So again, you can say that this is nothing but working capital purpose only. So there is a overall all-in cost ceiling per annum is also there. So first of all, benchmark rate plus 450 basis point spread, and it is a maximum which is permitted. What is the benchmark rate? Benchmark rate in case of foreign currency denominated ECB, it refers to 6-month LIBOR. And in the case of rupee denominated ECB, then yield of the Government of India securities of corresponding maturity will be taken as the benchmark rate, and over and above the benchmark rate, maximum 450 basis point can be the spread which can be offered to. This is the all-in cost ceiling, not only the interest but all-in cost ceiling. All-in cost ceiling. So that's in fact what I wanted to say. Rate of interest, other fees, expenses, everything is included here. So ECB can be raised through two routes. One is called automatic route and other is called approval route or government route. Under the approval route, the prospective borrowers are required to send their request to RBI through their AD banks for examination. And whereas in the case of automatic route, the powers has been delegated by the RBI to AD banks only, and then they take care of the requirement there. They examine the case. So far as limits and leverages are concerned, then all eligible borrowers can raise ECB up to USD 750 million or equivalent per financial year under the automatic route. And further, in the case of foreign currency denominated ECB, if it is raised from direct foreign equity holder, then ECB liability equity ratio for ECB raised under the automatic route cannot exceed 7:1. So because you see, we have mentioned about raising foreign currency denominated ECB from foreign equity holder. So in both the situations, this overall limit ratio is given, which is should not exceed 7:1. So these were, I'm sorry, I may have been rushing because there's a lot to cover and I have just another 30 minutes left. So maybe few questions must be there in your mind. So let's, you please hold those questions, and then in the question answer session, I'll take up those questions. Now let us look at the second aspect of corporate borrowings, which is the disclosure requirements. So, so far as disclosure is concerned, when we look at the Companies Act itself, as per the requirement, of course, once the special resolution, all those are filed with the registrar of companies, they become public document, anybody can see them. And since it is a special resolution, it goes to all the shareholders. But another very important disclosure requirement is through the financial statements of the company, which they publish on annual basis. As you are all aware that as per section 29, company prepares its financial statement in the format prescribed in schedule 3 and after complying with the various accounting standards as prescribed in section 133. So let us look at schedule 3 first, where what type of information is a company is required to disclose with respect to corporate borrowings. So first, let us see the division 1, part 1 of the balance sheet. Now you can see here that there are non-current liabilities where long-term borrowings are to be reflected, and under the head current liabilities, short-term borrowings are required to be disclosed. When we come to division 2, part 1 of the balance sheet, then you can see here under the head non-current liabilities, financial liabilities, and then the very first column is borrowings. And similarly, in the case of current liabilities, under the head financial liabilities, borrowings is required to be shown separately for non-current and current respectively. Along with the balance sheet, you would also see the the instructions which are attached to the financial the format of balance sheet, which is part 1. There are certain instructions also mentioned, and in the instruction you will see that it says that when you are classifying long-term borrowings, then what are the information which you are required to give. So it's so far as division 1 is concerned, it says that bonds, debentures, term loan from banks and from other parties, deposits, loans and advances from related parties, these are to be shown separately. Then there are certain other very important instructions. Borrowing shall further be subclassified as secured and unsecured. Nature of security shall be specified separately in each case. Where loan has been guaranteed by directors, the aggregate amount of such loan under each head shall be disclosed. Bonds, debentures, along with the rate of interest, particulars of redemption, conversion, shall be stated in descending order of maturity or conversion, as the case may be. Where bonds, debentures are redeemable by installments, the date of maturity for this purpose must be reckoned as the date on which the first installment become due, and this is just an instruction. Terms of repayment of term loan and other loan shall be stated. Period and amount of continuing default as on the balance sheet date in repayment of loan shall be specified separately in each case. So these are mandatory requirement, disclosure requirement, which is given in schedule 3 itself. Similarly, in the case of short-term borrowings, the classification of short-term borrowings so far as division 1 is concerned, you can see here loans repayable on demand from bank, from other parties, and loans and advances from related parties, then deposits and other loans and advances, repayable on demand from banks and from other, and then B, C, D. These are the broad heads, and then A and B from banks and there is inside. So borrowing shall further be again same class, secured and unsecured. Nature of security is to be specified. If guaranteed by directors, then it should be then on the period and amount of default. Now this is one such information which practically I have seen missing in number of financial statements. Period and amount of default as on the balance sheet date in repayment of loan and interest. So, I mean, of course, we have seen this reporting in various reporting by the auditors in their Caro report, but company is also required to disclose this in the note relating to short-term borrowings or long-term borrowings, as the case may be. Current maturities of long-term borrowings shall be disclosed separately. Now, if we look at the similar situation in the case of Division 2, now, so far as non-current borrowings are concerned, bonds and debentures, then term loans, deposits, and loan from related parties, and virtually the same nature of security. I think this I can skip. These are just from, you can see from the Division 2 Part 1 balance sheet. And so far as current borrowings are concerned, these are the information which is required to be disclosed, and that this is the way how it is required to be disclosed. Then for both Division 1 and for Division 2, there are certain additional regulatory information which relating to corporate borrowings. I can point out at least 3 additional regulatory information which is required to be disclosed by way of note in the financial statement. First, where the company has borrowing from banks or institution on the basis of security of current assets, it shall disclose that the quarterly returns have been filed by the company and are in agreement with books of accounts. If not, then a summary of reconciliation and a reason for material discrepancy. If material discrepancy is 25% or more, then it is required to be disclosed. So this is one additional regulatory information to be provided by the companies with regard to the corporate borrowing. Second is where company is declared willful defaulter by any bank or institution, then when the company was declared willful defaulter, and what are the details of default, the amount as well as the nature of default is required to be given. And third one, additional regulatory information is with regard to the charges and satisfaction of charge, where any charge or satisfaction yet to be registered with the registrar of companies beyond the statutory period, the details and reason thereof shall be disclosed. So these are some additional regulatory information. So when we come to the disclosure requirement under listing agreement, or rather listing obligation and disclosure requirement regulation 2015, then you can see here a very large number of regulations are there. There are specific obligations which are applicable to various type of entities. For example, obligation of a listed entity which has listed its specified securities and non-convertible securities, whether it is on main board or SME exchange or on innovators growth platform where this startups are raising money now. So that regulation 15 to 48, if you see the entire gamut of disclosure requirement, even the constitution of the audit committee, related party disclosure, and that is all mentioned there. Then obligation of listed entity which has listed its non-convertible securities, for that regulation 49 to 62A are there, and which requires to be complied with by the listed entity. Similarly, non-convertible securities, it's specified securities and non-convertible securities, then 15 to 48 are the additional regulatory requirement which are required to be complied with. So without going much detail into this, let me come to the last part of today's topic, that is the governance aspect of corporate borrowings. Once again, we will look at it from uh, from the statutory requirement perspective. So, first of all, from the Companies Act perspective, there are, I would say, three very important aspects which we can say are the governance related aspects relating to corporate borrowing. The very first is Section 77 to 87, which deals with registration of charge and satisfaction of charge. The second is borrowing from directors and other related parties. Then there is some specific requirement which I'll just explain you. And then, of course, the another layer of governance process, which is the statutory audit. There, statutory auditors are have been asked to comply with the have to ensure that the company has complied with various accounting standards, especially when we talk about the corporate borrowings, then borrowing costs, related party disclosures. These are some of the, and of course the financial instrument, all those are there. So, and then there are number of aspects which on which the statutory auditor is required to report under CARO. So let's look at these aspects. Registration of charge. So what is charge? Section 2, clause 16 explains. It says that charge means an interest or lien created on the property or asset of a company or any of its undertaking or both as security and includes a mortgage. So technically we'll say that whenever there is a secured borrowing, then charge is the charge aspect is required to be registered with, which is as per the requirement of Section 77, which requires companies to register charge with the, and this required to be filed in various forms, CSG 1 or CSG 9, with the registrar of companies within 30 days of creation. And then if company fails to do that, then the charge holder, because you see the company is duty bound to do that, but the institution or bank or the lender is considered as charge holder. He is also authorized under Section 78 to apply if the company does not apply in 30 days, then he has got next 14 days to notify to get it registered, the charge registration. Registration provides public notice to the charge, giving the charge holder priority over other creditors, and failure to register carries penalties. So, registration of charge is such an important aspect, or I would say the governance aspect of the corporate borrowing, because when we really look at the various litigation which is either going on in before the NCLT through under the IBC or otherwise in various courts, we have seen that registration charge become the issue of charge being registered takes a very important step in those proceedings. I'll just give you a few flavor of 2-3 case laws which are there with regard to registration charge. The very first one is this is again since it is a very common issue, that's why I included this. Number of times companies take a loan against fixed deposits, against their own fixed deposits. So technically it is a charge against the asset of the company, but the court have decided that it is not necessary to register a pledge in respect of fixed deposits at a charge. So the particular case which can be seen here is Vikramjit. This is Madras High Court judgment 2020, Vikramjit Singh Oberoi and others versus ROC, which has been reported in 157 CLA 136. And the second one is the registration of charge does not apply to corporate insolvency resolution process. Though whether registered or not, they have to prove, everyone has to prove that whether it's a secured creditor or not. But as such, the registration of charge does not apply to CIRP. That is again decided by NCLAT, Appellate Authority, New Delhi. Then third case, which you can refer in this, which is an important one, is civil court cannot entertain a suit for any matter that the tribunal is empowered to decide. This is though the what word I have used is looks very general, but it is a case where the one person was trying to through the civil court trying to take possession of a property which was otherwise charged. So it was claimed that the property which is charged can only be handled by the tribunal and not by the civil court. That's what Calcutta High Court decided in this Meenakshi Periwal case. So these were few important cases with regard to registration of charge. Now, when we talk about borrowing from directors and other related parties, because number of times it has been seen that related parties have been used to siphon off funds of the company. Of course, in this case, it is not siphoning of the funds, but definitely by paying higher interest, taking loan at a higher interest, and all those. So, in relation to that, you can see, I would say, three important sections which we must consider. The first is Section 184, where disclosure of interest of directors. So each year directors has to at the beginning of the year itself they have to disclose that what are those entities in which they are interested, their relatives, and all that information. And then Rule 13 of the Companies Meeting of Board and Powers Rules 2014 is also read with Section 184 itself, because the entire process of filing that form and giving that information in the first board meeting is prescribed in Rule 13. Similarly, Section 189 talks about a register to be maintained of contracts or arrangement in which directors are interested. So if there is any borrowing from directors and other related parties, that has to be recorded in Section 189. Another important section to which I would like to bring your attention is Section 177. So see, Section 177, when we come to Companies Act, or rather when we talk about related party transactions, then straight away we go to Section 188, and then we say that then audit committee is primarily looking into or giving permission or is approving the transactions which are covered in Section 188. But if you look at Section 177, where the audit committee, wherever the audit committee is required to be formed, then it says that the audit committee's terms of reference must include. This is the one of the important term of reference for audit committee is that making recommendation to the board of transaction other than referred in Section 188, as well as scrutiny of intercorporate loans. So it does not mean, I mean, don't be under this impression that Section 177 only, where audit committee deals only with the transaction 180, which are referred in Section 188. But for other transactions also, he has to, so far as intercorporate loans are concerned, audit committee has to scrutinize them. And for other transaction related party transaction, because all related party transaction has to be approved by the board. So for that purpose, a recommendation to the board whether that transaction is at arm's length basis in the ordinary course of business, and all those aspects. Based on that, audit committee's recommendation must go to the board for final approval. So these are, I would say, the three important sections here. Now, coming to the last part of on the governance part, I would say that the statutory auditors have also been given a very important duty to report on various aspects of corporate borrowings, and that is through their auditors report under company's auditors report order 2020, which you can see here. I think there are almost like 6-7 places where there is a reference of corporate borrowings. For example, if you look at clause 2 and subclause B, it says whether during any point of time the company has been sanctioned working capital limit. Now, these are again in excess of 5 crores, then auditor is required to comment on that. That is one. You remember that this was the additional regulatory information which company was also required to report in the financial statement, and the regulator must have thought it important. Therefore, they have added this in CARO 2020 also to report from the auditor's point of view whether they are in agreement with the books of accounts, all the quarterly returns which has been filed with the bank for working capitals limits secured against the current assets of the company. Secondly, clause 5, you can see here, this is with regard to the deposits. In respect to deposit accepted by the company and amount which are deemed to be deposit, whether deposit, the directive issued by the section 70 through to 76. All those information is all those reporting is so far as deposits, public deposits are concerned, that has to be reported under clause 5. Any default, any order passed, not complied with, all that has to be reported by the auditors here. Similarly, you can see in para 9 is all 6, at least 6 items in para 9 are relating to. First, sir, I'm just going to complete, then we will take questions. Is that 2-3 minutes? So whether the company has defaulted in repayment of loans and other borrowings in the payment of interest thereon to any lender, if yes, the period and amount of default. Similarly, para 9B, whether the company is declared willful defaulter. 9C, whether term loans were applied for purposes for which loans were obtained. If not, the amount of loans were diverted and the purpose for which is used may be reported. Similarly, para D, short-term basis has been used for long-term purposes, then it is required to be reported. 9E, that whether the company has taken any fund from any entity or person on account of or to meet the obligation of its subsidiaries, associates, and joint ventures. The purpose here, the auditor is commenting on the purpose of corporate borrowing. Similarly, in para 9F, where the company has raised loan during the year on pledge of securities held in subsidiary or joint venture. If so, give the details of all that. So you can see here, even the auditors, as part of the corporate governance culture is required to report on various aspects of corporate borrowings. I think with this, I will just conclude, and then we can take questions now.
Thank you very much, sir, for the insightful and deeper understanding on the corporate borrowings, governance, regulatory insight. We have got very good deeper understanding and compliances requirement of the borrowings, be it domestic or international. Thank you, sir. So, sir, we have some certain questionnaires from the members.
Sure.
If you allow me, we can take one by one. The first question is from a governance perspective, what are the key responsibilities of the board and independent directors when approving significant borrowings?
Okay. So if you look at the audit committee, see, audit committee, if the constitution of audit committee, especially if it is a listed entity, then it is majority of them is independent director. And the chairman of the audit committee is again a person who has who is a financially literate, and he has a special knowledge of finances. As I mentioned to you in section 177 itself, it is mentioned that audit committee has to see, excluding transaction in section 188, then see all the related party transactions for which it has to go to the board for approval, but it has to be recommended by the audit committee. Intercorporate borrowings has to be specifically reviewed by the audit committee. So independent directors as part of audit committee, as well as part of the board, when finally those transactions come to the board for approval, there they have to really view all those transactions in a very, very judicious manner, and ensure that these related party transactions or if there is whether they are being executed at a arm's length basis in a terms which are not prejudicial to the interest of the company.
Right, sir. So second question is, what are the most common disclosure gaps in financial statements and board reports regarding corporate borrowings?
Pardon? Please come again.
What are the most common disclosure gaps in financial statements and board reports regarding corporate borrowings?
You see, I won't say there is a major gaps in that, but we can say that, you see, we have seen that the financial statement requires certain disclosure, very specific disclosure on the face of it, on the face of the balance sheet, in very detailed information in the notes, as well as by way of notes to accounts, and which is, I just mentioned about the additional regulatory information. If first of all, the company should not be missing that information, or if that information, if ideally any non-compliance which is reported there should always be a part of the director's report, and director should specifically give a comment on the non-compliance part of it, the reason why it has not complied with, and all that. And similar can be the point when auditor has given any qualification or has made any qualified report with regard to the various issues on corporate borrowings, then the director's report should have a very detailed explanation to that. Only then this will give a will make the corporate governance work properly.
Sir. So next question is, in your experience, which governance lapses related to borrowing decisions have attracted regulatory scrutiny in recent years?
Okay, so see, if you look at see various orders passed by NAFRA, that is onto the audit quality review primarily, I would say that majority of them are relating to related party transaction, and those are asset side of the balance sheet, which is the see loans and investments in subsidiaries, joint ventures and associates. And but look at from this point of view, if they are making an observation on the asset side, it means on the liability side also on the other companies the same argument would stand. So for example, what I'm trying to say that if you look at especially ILFS case, see and look at various NAFRA orders there, they have very categorically pointed out that the auditor of that company, of those companies, have not highlighted, and they have not really gone into the quality of borrowings, or rather the loans and investments made. The similar case applies to the other side. So and see, if you remember that in section 143, there is some additional reporting requirement through rule 11, which has been brought in. It says that when a particular loan is taken or funds is raised with the intention with a very clear understanding that it has to be given to someone else for and to avoid non-compliance, to avoid compliance of a particular section, it is a serious observation. And then therefore now auditors are specifically required to make that comment. But this gives a background that related party transactions, even in corporate borrowings, so is a very area of concern. And see, I have seen number of cases in practice also where the one company has raised the funds based on its strength or security and given it to other company. And for other company, which is the group company, though you will say that what is their problem if they are getting funds as unsecured loan from its holding company, or let's say from associate company. But in a broader perspective, those loans in the other company were not used for the purpose for it was raised, or for purpose it was there. So looking at the overall situation, let's say if we really examine the consolidated financial statement, these issues will definitely make a serious issue. So that is the point which I am trying to say, that intercorporate transactions, even in corporate borrowings, is a serious lapses which has been seen by the regulators.
Thank you for that.
The how should
Yeah.
Sorry.
Rajat, you can continue.
So next question is, hello.
Yeah. Please go ahead.
Yeah. The next question is,
I think he's facing some technical problems, so we are not able to log in, sir. I'll take up the next question. Member has asked, as a chartered accountant advising a mid-sized company, how can we help design a robust internal framework for borrowings covering sanction, utilization, repayment, and disclosure?
Okay, that's good. First of all, see, a very fair assessment of the requirement of the company. That is very important. And I would support that what I'm saying with the findings of various companies where, especially in the initial period of NCLT, when the various power sector companies failed, then it was found that the very basis on which their projections were made and loans were raised, that was defective. So the very basis of making an assessment of the requirement of the company, it's the best help a chartered accountant can provide to a corporate client, that what is their actual requirement. And then based on that and looking at the at the security available and examining various sources from where a boutique of facilities can be availed to maximize the availability of funds and minimize the cost. So that's the exercise which a chartered accountant should do, and without hiding any aspect of it, because a number of times where projects fail are when they are making an assessment of the requirement and also working out the promoter's contribution, and there they are not willing or they are not in a position to contribute that much. So in those situations, I think we should be very straightforward in explaining that unless you bring in your promoter's contribution, so much funds cannot be raised.
Thank you, sir. Another question we have received is, can you please guide us on some best practices for disclosing borrowing arrangements without compromising sensitive commercial information?
I think I would not be experimenting with any additional disclosure requirement. If you look at Schedule 3, I have explained you in detail. If all those information is there, I think that is good enough. And it's a wholesome information which is going to be to the stakeholder, along with the when the stakeholder reads that information along with the auditor's report, the situation is quite clear. I don't think there is any gap for the time being, and I don't want to introduce anything further. And in fact, I have been blamed for introducing few additional requirement in Caro when I was part of that committee. I was told I was also during that period independent director in UCO Bank. So from bank's perspective, I suggested, and I could, and of course with the help of others, we could introduce few important reporting requirements. But now a lot of practitioners say that that was not a very good idea. Anyhow, so that apart. So I would say that at the moment, present requirement of disclosure requirements are good enough. Let's ensure that they are being reflected in letter and spirit.
We got many questions, sir, but looking at the time, I would just take one last questions we have received from member. A listed company's debt to equity ratio has suddenly increased from 1:2:1 to 3:5:1 within 1 year. As a member of the audit committee, what governance red flags should we look for before improving further borrowing proposals?
Yeah, it's a very interesting, should be a case study. So, if you look at the debt equity ratio, if it is not over a period, it is when the company is going into an expansion mode and the institution and bank has helped the company to raise certain funds, and it is a running company and company is showing good profits, even this ratio is okay. But one has to be very careful that it is not a static situation. It is a dynamic situation, and this ratios are appearing only for a very short period. Otherwise, it is an alarming signal.
Because for us, are you talking about vendors?
Yes.
Jatin sir, I would request you to please mute yourself. I think there's some disturbance in the line.
You have a sort of NOC that we would require, right?
Yes. This was one from the party where we have to take NOC. We might have to take NOC from the
Sir, you can continue.
Finish the answer if you have another question.
Okay. So, though we had many more questions coming in, but looking at the paucity of time, sir, we will have to close it right now. So, on behalf of the Corporate Laws and Corporate Governance Committee of ICI, our Chairman, CA Babu Ibrahim, sir, Vice Chairperson, CA Preeti Savla, we extend our heartfelt thanks to you, sir, for sharing your valuable insights on this session. Your practical perspective, along with the regulatory guidance, this will certainly help all the professionals and corporates strengthen their governance and compliance practices. I would also like to thank our moderators for taking up the sessions. And I would also like to thank all the participants for actively engaging in these sessions and contributing through the questions for success of this webinar. We look forward for many more opportunities with you, sir.
Yeah, thank you very much, Simaji, for inviting me.
Thank you. Thank you, everyone. Thank you for joining us. Please end.